there is actually quite an interesting trade idea that's popped into my head recently. It's through some questions people have asked, and through me kind of looking at this this VIX October again, right? So the VIX October obviously is I think flawed, right? Because if you think about where the floor tends to be in VIX, it tends to be at about 12. Okay. And then if we think about with the election coming up, where October VIX is going to trade, that's going to capture the November implied vol, right? And the November implied vol is going to capture a perceived gap on the election. And as the election is becoming more and more uncertain, because it's kind of like a coin toss between Harris and Trump, or Harris is slightly overtaken in the polls, in theory, that uncertainty is quite high. So as we get closer and closer to the election, I think that VIX forward vol that is going to be pricing the October of the future, it's going to struggle really to go down from 16, I think, right? So if that's the case, then selling, well, if you could sell outright puts, but probably put spreads makes more sense just to keep your margin down. So selling to collect some premium, you can probably take in about 50 to 55 cents for that option, for that put spread, okay? And I think there's a very, very low probability of us breaching 16 for October expiry, okay? Now, if the market sells off from here, then you're even more likely to not be anywhere near 16. But if the market just kind of chills out and does nothing from here, we're currently at 18.5 on October VIX. So there is some roll down still for it to get to 16. That's currently where September VIX is trading right now. But I think it's going to struggle to breach 16. So if you agree with that viewpoint, you can sell that put spread, take that 55 cents of premium, and do that in a size that you're willing to put up the margin for on that put spread. So effectively, it's like 3-to-1, right? If you put $150 of margin, you collect $55 of premium. You can then go and spend that premium on a bullish structure on S&P. So obviously, this VIX call is like, it's not really a delta call, right? It's not really that we're particularly bearish on the S&P. We just think in all scenarios, VIX October is going to struggle to break 16. If the market sells off, it's going to be nowhere near 16. And if the market's flat to higher, we think it's going to kind of find a floor at 16 anyway. Okay. So then you can use that premium and you can buy some upside on S&P or SPY to basically benefit from the idea that, okay, well, if we continue rallying from here, I don't think my October structure is really going to go through that 16 strike. And then the premium I can use on something that multiplies in value, right? And I think the kind of structure that would work quite nicely for that is like a September, October call calendar on SPY. So if we go quite out of the money, right? That costs around $130 for one contract, right? So you can kind of size it in a way where you're not spending any premium. Whatever you collect on the bull put spread on VIX October, you spend on the set oct call calendar on SPY. And then if nothing happens and the VIX October doesn't break 16 and the S&P doesn't rally, then you've spent no premium. If the market sells off, the S&P that is sells off, the October probably maxes out and you get to keep that premium and you make no money on the calendar because all the calls go to zero. But there is a scenario where the market rallies, vol starts to float on the upside, i.e. the VIX can't go any lower, struggles to go lower, and the call calendar explodes in value and multiplies by like 2, 3, 4 times what you paid for it, basically. All right. So I think this is a really cheap way to get exposure to a melt up in stocks without really having to spend any premium or be particularly committal about it. Because we're talking about chasing the market at the local high. But I strongly believe it could be at 5,800 before you know it, right, this thing. So I think that's quite a nice way to play it. Like people were asking me about the relative value between VVIX and VIX and is there a trade here? And I've kind of landed on this idea where I think selling put spreads on October VIX to fund call calendars on SPY is kind of the smartest way to use that relative value and the fact that vol is still a little bit elevated I think that's the way I would do it. Okay, so that's your macro melt up hedge, whatever you want to call it, trade idea for the day. Let me know what you think. Definitely going to be, if we do this one, it will be in the Vega part of the book as a bit of a relative value play. But essentially, where it makes a load of money is if the market goes higher and vol doesn't go any lower, basically. Vol kind of floats, right? Which I think is quite realistic given the upside vol's at 10 already. That if we do start ripping and go towards 5,800, vol is not about to get hammered. Vol will stay pretty firm at 10, I would have thought, right? On those upsides. All right, guys. That's it for today. I'll catch you all tomorrow. Cheers.
Hi, everyone. Thanks for making it to the end of the video. Remember, this is just a little taster of what we do at Options Insight. To get access to all our research, including my in-depth vol market insights, flows and positioning report, and my portfolio trades, and a whole lot more, you can sign up for a free 1-month trial at options-insight.com.